My name is Rick Patel. I'm back again with Locumstory, and we are doing a talk today about taxes. This is going to be a really great discussion because I think so many people have so many questions about taxes, how to go about doing taxes, S Corp, LLCs, all these things that we may or may not know. And we've got two really wonderful speakers who are going to be here to talk about it. As I always say, Locumstory is an educational website all about locums work, how it works, and there's so many resources on the website you should check out if you have any more questions. So my two speakers today are Skylar Campbell and Alexis Gallati. Skylar and Alexis are both CPAs, and they both work at separate firms. I'll let them introduce themselves before we get started. Skylar, you want to start first?
Sure. My name is Skylar Campbell. I currently am in Las Vegas. I've been a CPA for about 6 years now. Been in the tax industry for over a decade. I moved down here to Las Vegas from Utah to join the firm that I'm with. I worked with them as a tax manager for about a year before becoming a partner, and have been partner here for about 5 or 6 years now, and enjoy what I do. And then our firm focuses on locum tenens on the kind of intricate difficulties that they experience by having several different jobs and locations and states and stuff like that. So yeah, I'm happy to be on this webinar and look forward to answering some questions for you.
Great, thanks, Skylar. In full disclosure, I found Skylar looking for somebody that would do sort of bookkeeping, my business taxes. I work in multiple states, having individual locums practice, and so that's how I kind of found Skylar, and it's been a great relationship so far. Alexis, do you want to introduce yourself for us as well?
Yeah, definitely. Thank you so much for having me here. Yeah, I'm Alexis Gallati. I am located in Knoxville, Tennessee. I have been doing taxes in this industry for over 18 years. For about 12 to 13 years, I was working for local and regional CPA firms before going out on my own. And I specifically developed Cerebral Tax Advisors, my firm, to focus on tax planning, proactive tax planning throughout the year, as well as providing the compliance and audit protection, et cetera, for my clients. And I work specifically with high net worth physicians as well as business owners. My husband's a physician as well. He is a neurosurgeon here in the Knoxville area. So, and we met like the second week of college. So we've been all over the place between New York and Massachusetts, Georgia, all over the place when it comes to different states and just the different financial issues that physicians have. And I specialize in multi-state as well. And so I have, my firm's 100% virtual, and we work with taxpayers all over the world.
Great, wonderful, thanks. Briefly, for our newer participants, Locumstory, as I mentioned before, is an educational website. You guys, the panelists, we're going to be speaking, people that are participating, you can't be seen or heard. If you have any questions, just add them onto the Q&A section. If you're having any technical difficulties, log in, log out. I'm actually on shift right now, and I'm in a dodgy Wi-Fi, as I'm just finding out now. So if I get logged out, I will probably have to log back in, just a heads up, and then we have a backup contingency plan for that. And then we're recording this, of course, and so if you have any want to watch it again or refer it to people, then we'll have that link up on the website. So that should pretty much be it. I guess we could just start with some questions. There's so many great questions on here, and I guess I'm just going to start with my own question, which I know all doctors ask, is what is the difference between the LLC, the S Corp, and the C Corp, and what advantages do they offer, and which one? I'm hoping, Skylar, because we're on an S Corp, and I'm hoping we're on the right one there. But Skylar, you want to start first with that one?
Yeah, so there are pros and cons to each of them, and to be honest, there's not a one size fits all that's best for every single locums. Everything is circumstantial, depends on the circumstance you're in, depends on The tax savings you're looking for, it depends on how much you're wanting to contribute to retirement. There's several factors to take into consideration when determining what kind of entity to set up. The most important thing is having that LLC set up to have the liability protection of separating business assets from personal assets, and in case anything ever happens. But with an LLC, you can be taxed as either partnership or as a sole proprietor. There's a lot more flexibility involved with that, and makes some ways, I guess, a little bit easier in dealing with multiple state tax issues. But with an S Corp, which is the way we have Dr. Patel set up, there's definitely some tax saving strategies with there as well, and also allows you to have some more flexibility with retirement contributions. As a self-employed person, like locums generally are, there are a lot more opportunities to contribute more towards taxes as compared to being a W-2 employee for somebody else. The income or the amount you can contribute is higher every year. There's multiple different types of retirement plans available for self-employed individuals, and then there's also C Corps, which I'm not going to say never is a good situation for locums, but generally, because of the way that the tax structure is with LLCs and S Corps, that's generally how we set up our locums, just because of tax savings, where there's double taxation with a C Corp, where you're taxed on the business level as well as the personal level. Whereas with S Corps and LLCs, you're only taxed at the individual level. That income flows through to you on a personal level, and generally ends up saving you more in taxes as compared to a C Corp. So like I said, there's not a one size fits all perfect scenario for each type of situation, but I'm sure Alexa can attest to that you got to look at every situation and see what's the best situation for you individually, and use that for your business going forward.
Great. Alexis, you want to chime in on anything on that?
Yeah, definitely. So the way that I always like to approach it is, and I like to explain first to my clients, is that an LLC is a state-formed entity. Because a lot of people think that an S Corp is an entity unto itself, but it's actually just a tax election. And so if you set yourself up as an LLC, so actually for most physicians, you have to end up being a PLLC, which it's also important to understand which states. Some have PLLCs and some don't. So like California, for example, does not have PLLCs, and PLLC is a professional LLC. And as a licensed professional, you have to be a PLLC, and even if someone like myself being a licensed professional. So what's really important is to know what's allowed in your state. And then as like being a PLLC, as Skylar had mentioned, you can be taxed as like a sole proprietorship. You can be taxed as a partnership. You can be taxed as an S Corp. You can even be taxed as a C Corp, depending on the election that you make. And so, and it's also important to realize as well, like in California, again, that you can only actually be structured as a C Corp, and then you make the S Corp election. So make sure that you understand not only the state that you're forming the entity in, but also the states that you're going to be working in as well. Because like go to Illinois, for example, they don't have professional corporations. They have professional service corporations. So they're PSs. It's wonky. Every state has their own rules. So it's really important to know those. And just like Skylar mentioned, it really depends on your situation, how much you're making, on whether to even become an S Corp, because you have to take a look at the new, not the new, but it's been around for a couple of years, the 199A deduction, that QBI deduction, which is an automatic 20% haircut. And that really goes and helps when you're in sole proprietorship, or taxed as a sole proprietorship, as a disregarded entity, as just a single member PLLC. It can really be a huge factor before you even start to look at that S Corp. So now, is that going to stick around with the new administration? I'm not sure, but that's the real important part of that proactive planning, is to continue to always look at, and tweak and modify your plan as the years go on and things change.
Yeah. Alex, I'll stay with you on this one, and Skylar can jump in on this question. People going at taxes themselves, I know a lot of my colleagues try to go at it themselves, versus I think what I was doing was I was with a company that I wasn't really thrilled about, because one, the communication wasn't great, and obviously we're very busy. And two, if you come to me, my job is to explain to you medically what's going on, not for you to have to understand it yourself. But I need to do it in a way that's just simple, but I'm supposed to be your proponent there. And I think with my prior company I was with, it was just much more challenging. But I also felt on that another aspect, they weren't really skilled in kind of locums, multi-state. So what's the benefit of, maybe not going out? Why should you maybe not go at it alone, which I never would anyway? What's the benefit of finding places that do kind of like, I guess like you guys or your colleagues that do these multi-state, like you guys focus on physicians? What advantages kind of are offered there?
Yeah, great question.
I was like 10 questions in one. I'm sorry.
Pardon?
I was like 10 questions in one. I'm sorry.
That's okay. I think I got the gist of it.
Okay.
One thing I want to mention before I talk about why it's important to work with someone that obviously has the experience, is that there are opportunities and there are cases where you could even do it on your own. And I know that sounds weird coming from someone in the profession, but I have some clients where they are just doing locum work in one state. They have family nearby, they don't want to go too far. And so they're just working around hospitals in their area or within the state. And so that makes it a lot easier. Where things can start to get really complicated is really, especially if you're at like an S Corp or a C Corp and you have to pay yourself on payroll, is those payroll taxes, and making sure that you're reporting the proper payroll amount in each of those states, having the withholdings done properly in those states, making sure that you're registering foreign qualifying your business in each of the states you're working in. So it can be quite overwhelming. And, face it, I mean, most docs I know, including my husband, I mean, you guys are busy. And you guys are more than capable. You're really smart. You can go out there and look at, but what you're going and essentially, gaining from working with someone like Skylar or I is that you're getting the answers quickly. It's going to be accurate, and it's if it's not going to something that isn't going to be accurate, you have someone that will take care of it for you and make it right, and etc. Where if you were to go and mess something up, that TurboTax box is not going to just someone that's not going to jump out and help you.
Yeah, no, absolutely.
But yeah, communication is extremely important, and working with someone that works with other physicians is really important. I'm sure Skylar can attest that you guys have wonky hours, and being able to working with someone that has their practice in such a way that makes it really efficient, and using a lot of video conferencing, or even doing videos of projections, sending it to you. You can watch it while you're on call. And then we set up a meeting to talk, and it's just so much more efficient, and allows you to really go and make more use of the time, better use of the time.
Great. Wonderful. Somebody asked, Scott, if you want to field this one, about international locums. Most of us are in state, but there are a lot of international assignments. How to avoid basically double taxation here and in the country you're working in.
So I'll be honest on this one. I don't do a lot with international. So if Alexis, you have expertise in that area, I'll defer to you on that one. I wouldn't want to give any advice that I'm not familiar with. So I don't do international work. So
yeah, no worries.
I don't want to give any bad advice on that one.
I don't take out appendixes, but they still want me to do it anyway.
Right.
Yeah, sure. Great question. So most of the time when you're in another country, it depends on if there's a treaty involved, if you know, whether or not you have to even pay any taxes. But if you do, what happens is the US government gives you a credit for the federal tax, for the foreign tax that you pay in the other country. So it's almost the same sort of idea when, let's say that you're a New York resident and I shouldn't use New York because that's way too much higher. Let's say you're in Tennessee and you go to New York to go and do some work there. Well, you're not being taxed in Tennessee because there's no state tax, but you are being taxed in New York. And so if you were, I guess Tennessee was actually a bad thing. If I were to be taxed in Tennessee, I would get a credit for New York state tax on my Tennessee return. And
Right.
so it's the same sort of idea with, you know, if you were to go overseas and pay tax overseas, yes, you would get taxed on that income, but you would get a credit for it. And now one thing to also mention too, it just depends as well how long you're over there. Because if you can meet sort of some bona fide residence tests or physical presence tests, then it changes every year. I want to say it's maybe like $100,000 or something is not up to that amount isn't taxable, and then anything over that would be. So there's a few hoops you got to jump through with that, and it gets a little more complicated. But there's definitely, you know, the IRS, believe it or not, doesn't want to try to double tax you on something if you're not, you know, you don't have to, basically.
Yeah, yeah. The base question, just about 1099 versus employee. I think that's a really common thing that we come across. I know Scott and I, we were talking about this because my academic position is W-2, but then my other are 1099. Skylar, do you just want to like break down the benefits, I guess, of being 1099, why hospitals or staffing companies for all specialties sort of do 1099? What is their viewpoint on it, and what we can benefit from it as well as physicians?
Yeah, that's a great question. So in my opinion, or I guess not my opinion, but I think the big reason that the hospitals do that is one, flexibility on both ends. If there's a doctor that's able to work hours that someone normally wouldn't, that they'd be, you know, they can hire them on for a short term, or I guess kind of spreads the liability a little bit more on the doctor as versus the hospital. But it also provides the locum the flexibility to work when they want. I just talked to a new client yesterday that had been a W-2 for 5 years, and he was working long hours, and he just said, I wanted some flexibility to be able to spend time with my family, to work when I wanted, to be able to travel a little bit, to be able to, I mean, there's several reasons why it's great to be a 1099. Generally, they get paid more per hour because they're getting paid to cover payroll taxes and health insurance that a lot of times would be provided by the hospital or by the employer. But then on the other end of it too, there are several deductions that you can take as a 1099 employee, as a 1099 contractor versus a W-2 employee, which helps, again, helps with some flexibility for tax planning. Also, as I mentioned previously, as a 1099 contractor, you have a lot more options for retirement planning rather than just a 401k that an employer may offer or a profit plan. There's a lot more options available for a contractor. And so while it's not for everybody, some people enjoy showing up for work and knowing they have the consistency of one employer and one job, and that's great. There are a lot of people that, you know, obviously there's a lot of locums across the country that enjoy that flexibility to work 1 week in one area or for 6 months in a state and then go to another state and get to know, it's a good way to travel and get to know areas while getting paid to do it and enjoying what you're doing. And so for me, the biggest thing is flexibility, rather being in one area, in one job, and kind of being fixed to that position and to that area. It allows you to, it opens up options for retirement flexibility, taxes, being able to write off some stuff that you don't get to as a W-2 employee. And so it can be a great option for a lot of people.
Absolutely. And, going back to that 1092 option, I think for me, I know for anesthesiologists, for hospitalists, it's nice to work in a lot of different places because I guess, Alexis, like your husband's a neurosurgeon, a lot of times when you're in an established group, you're a little more stable at the hospital or wherever you work at. Whereas when you're in sort of shift work mode in corporate America healthcare, you just don't know what could happen tomorrow because you're a shift work physician, and sometimes it's a little easier to have you replaced. I don't mean that pessimistically, I mean that more realistically. So I think a lot of locums in all specialties like to diversify their risk, kind of like this portfolio, so that we work at so many places. I work in 4 other states, and a part of that is just for that reason, because it's a very high risk specialty, high risk, high liability, with many, many people scrutinizing what we do. And in that sense, if things don't kind of coordinate or align with my practice of what the hospital can want, I can just politely move out, thank you for the opportunity, and go somewhere else. And as a 1099, obviously you can do that. You're not employed at the hospital. Alexis, do you want to talk about things, I guess 2 things, what you can write off as a locums and ways you can save taxes doing locums?
Yeah, great question. So what you can write off, basically, you run it just like any other business. So you're able to write off anything that's not being reimbursed by your provider. So this could be meals, it can be incidentals. You can do any scrubs, your travel, any hotels that aren't being, basically anything that is not being reimbursed. Even the basic things like your office in the home. That can be a really big one, especially for locum provider or locum docs, because if you're able to establish your home, you have your office in your home, then you can go and deduct any commuting between your office and, the hospital, like if you're local, or to, any other place that you're going to. And so that can be a very big, good way to get additional deductions, and make sure that you're not just taking the standard deduction. Go and take the time to actually write out all of your expenses with your automobile, because a lot of people just assume, or they're lazy to just take the standard deduction, but it can really add up, especially if maybe, let's say you want to go and purchase a new vehicle and you're using it pretty much 100% for business, then you can go and write off a lot of that, even the purchase of the car. Overall, when it comes to being W-2 versus 1099 and the sort of tax planning and strategies you can use, Skylar hit it on the head a little bit earlier. The major things that you want to look at is making sure you're in the right entity. You want to make sure that you're in the right retirement account. And it's also very important to when you're looking at retirement, that you're not excluding yourself from doing other types of retirement. So for example, a lot of people are just going straight to that SEP IRA. The problem is that then you can't do your backdoor Roth when you do that SEP IRA. You need to make sure to have no retirement or no balance in any of your IRAs before the end of the year, so that you can do that backdoor Roth. So what you want to actually do is set up a 401k with profit sharing, and that will allow you to do that. If you want to be super aggressive with your retirement, you can even set up like a cash balance plan. And so that will really allow you to put away, depending on how old you are, how much you make, there's factors that go into that. That will allow you to put away a heck of a lot more than you could with just a 401k with profit sharing by itself. Next, if you have children or you even have a spouse, you can look at hiring them into the practice. Shifting, when you hire the spouse, that's more for being able to put more into retirement. It really doesn't help tax-wise, when it comes, because you have to pay payroll taxes on your spouse's salary. However, you're able to go and then contribute to their retirement based off of that income. With the kids, it's really great. You're able to shift their, let's just say you pay them $6,000 and you want them to put that into their Roth IRA. That's a deduction for your business. And so make sure that they're at least 7 years old, though. That's the court tested age. But we can talk more about that strategy if you want to at some point. But and then you want to look at other strategies as well. Especially if you have, if you're getting into other investments like rentals, or you're looking at things like conservation easements, or doing even the Augusta rule, which is renting your home out to your business. There's a plethora of different strategies when you're 1099, and when you're just W-2, you're basically maxing out your retirement, maxing out an HSA, going and trying to get as much covered by an accountable plan through your employer if they have it. And then, that's pretty much the extent of it with the W-2.
Yeah,
so absolutely. There's a lot more you can do. It really opens up the door.
Yeah, that's wonderful. That's wonderful. Skylar, for setting up an S Corp, a C Corp, an LLC, PLLC, somebody was asking, do you need a lawyer to do it? I actually don't even remember how I set mine up. I think I'd used an attorney and then it was set up. And then when I changed the name to our practice, I think I used LegalZoom. I don't really even recall now. But I know a lot of my residents that are coming out need to know, because they're so, and I don't blame them because I was the same way, oblivious to how this works. How do they go about setting one up? Or is it always attorneys? Can you guys do it? How does that work?
Yeah, so there are certain situations where I think it makes sense to use an attorney to get an entity set up. However, with the locums entity, I'm not sure it's entirely necessary. We can set those up. You can get it set up through LegalZoom, something like that. I'm certainly a little biased here, but I think there's a little bit more work into it than just going through LegalZoom.
Yeah.
But I do know clients that have set it up that way and it's been just fine. But it's also not a super complicated setup for the entity where there's just a single member owner. Operating agreement is pretty straightforward and simple. The articles of organization, again, are pretty straightforward and simple. There's not a whole lot into it. So that is something that we can get set up with it. And as Alexis mentioned earlier, setting the LLC doesn't necessarily mean that's how you're taxed. That's how you're set up with the state. How you're taxed can be determined either at the time you set it up as either a sole proprietor, as a partnership, as an S Corp or a C Corp, but that can also be changed down the road. So maybe in the first year, you're just getting set up, you don't have that much income or that much expenses. It doesn't make sense to necessarily set it up the first year that you set up the entity, but you can make that change down the road if your income goes up, or if you're wanting to kind of structure your retirement a little bit differently. So it's, how you get it set up doesn't have to be the way that it is going forward. But to be able to reverse it is kind of a big deal. So if you go from a sole proprietor to an S Corp, there's a certain amount of time that you have to wait and file some forms with the IRS to be able to change it back. So you don't want to jump the gun just right from the beginning, get the entity set up in the wrong way so that it creates some more headache and more paperwork down the road. Which is why I think it is smart to work with at least with your CPA or with an attorney to make sure the entity is set up from the beginning correctly, so it doesn't create more of a headache down the road.
Yeah. Alex, I'm just going to ask you a random question here. A lot of physicians are gung-ho. If you screw up your taxes, which...
Uh-oh, I think we lost him.
Yeah. Dr. Patel?
I am sure if I even attempted to do this, I would. And I'm out. Yeah, you guys still hear me? Sorry about that.
Yeah, we can hear you now.
I told you. We went 30 minutes without, so I'm pretty happy we made it. I was hoping, I think it's every 10 minutes there. So, woo. Hopefully I didn't freeze in this weird frame. I'm
You look like you were shishing us.
We may have one more though. So just, Yeah, I was going to ask you about going at taxes yourself. If there is a mistake made, and I know Skylar, there was one on mine, I think previously, which we're kind of dealing with right now. What are the repercussions, you know? And this is why, you know, I say like my house, I don't even know how to freaking change a light bulb in my house. And I don't bother because my handyman is like, listen, you do your thing in the ER, I'll do my thing in your home. Let me do my thing and you do your thing. And I believe in that a lot. And I believe in finding people that will kind of educate you on how we go about it so we can make informed decisions. But not promoting CPAs and accountants, I think they're all wonderful, but kind of what are the repercussions if something like that happens? I would assume it's just an audit or penalties or something, correct?
Yeah, it just depends on what issue the IRS or the state has with your return. Some of it can just be, hey, you forgot to include some interest on your return. And so they'll tell you how much you owe with interest and penalties and then go from there. But if, let's say you're just a sole proprietorship and they look at your return, which by the way, one other major positive for being an S corp is that they have much lower audit rates than Schedule C's. So that's one reason too. Even if you're worried about being audited, or maybe you're trying to do something screwy, which I hope not, you can even be an S corp and then go and do 100% of your earnings as salary, and then it still is taxed the same way as a Schedule C, but it's not going to be as likely flagged for audit or randomly chosen than if you were a Schedule C. So I'll get off my soapbox about that. But so when it comes to it, if let's say they're looking at your Schedule C, I mean, they could go and try to audit every single little line saying, hey, we want backup for everything. And so then that obviously is a lot more involved. It takes more time. The audit rate in general with individuals was, I think last year it was like 0.5% of, yeah, it was very, very low. And I'm sure you might have even seen something in article saying, oh, the IRS is doubling their efforts. It's like, well, great, it's going to be 1%.
That makes me happy because when my dad and I go out to dinner and we do talk about business stuff and he puts it on the business card, I'm like, Dad, he's like, well, it's business, but they'll never audit you. I'm like, well, it's not a good way to go about practicing, just to be safe. But he was saying the audit rate, I mean, obviously follow all the rules and everything, but it's reassuring to know at least.
Yeah, and so the thing is that one thing that I have in my practice is audit protection, because face it, when most people get that IRS letter in the mail, it's like the deer in the headlights. They start to freak out. And so it's just, at that point, save yourself anxiety and send it to someone who can just handle it for you. And, that we have special priority lines as practitioners to get to the IRS faster. You might have to spend 2-3 hours on the phone just waiting for them to pick up, and then guess what? They'll pick up and then they'll hang up. I'm sure as Skylar knows, it just drops. It's like it's so it really depends on the severity of the audit. If there's anything with if you have your S corp or your C corp, I highly recommend using a professional, just because of the intricacies. It's a little bit easier with the Schedule C's, but save yourself the headache, Yeah,
that's great. Thank you. Skylar, there's a couple of questions here. Sorry, I'm getting a lot of questions here, guys. I'm trying to get to them all while also
great questions,
a little general about everybody on participating. There's a great couple of questions here. I'm trying to meld them into one about retirement. And I know one of y'all touched up on it briefly, but can you just kind of simply explain 401k versus SEP IRA? Somebody had asked, can you roll the SEP IRA into the 401k? And then they had also asked, I think it's a really great question, which is sort of a CPA financial planner question, but how much, this is a very general question they asked, like how much do I need to retire? I don't know. The question I'm asking right now as I'm sitting here, like thinking about the patients I have to go see, but how much do I need to retire? And I think more of, I know my financial planner says, probably more than you think. And I think probably more than you think. But if there's any kind of rules or things that you could maybe guide some of the physicians and healthcare people on here, I'll let both of you guys fill that one. But yeah, Skylar, you want to go first on that one? The big one.
Yeah, so the biggest, so a SEP IRA and a 401k, depending on how you contribute to your 401k, are similar in some ways and very different in others. With a SEP IRA, you contribute 25% of whatever your self-employed income is. So if you're a sole proprietor, it's just whatever the net income from your business is, you can contribute 25% of that. As an S Corp owner, you pay yourself a salary as the employee of the company, and whatever 25% of that is that you're paying yourself as an employee of the company, you can contribute. And then as a 401k, you have to be doing payroll and paying yourself as an employee of the company. The benefit of having the 401k is you can contribute $19,500 as an employee. And then as Alexis mentioned, if you have a profit share with that 401k, then whatever your self-employment income is from the business, you can contribute 25% of that towards your 401k. I guess one of the benefits of the 401k is as an employee, you can contribute either to a regular tax deferred account, or you can contribute a portion of it or all of it as an employee to a Roth account. I guess a very basic explanation of tax deferred versus a Roth is a tax deferred account is you're getting a tax deduction now on whatever is being contributed. A Roth IRA or a Roth contribution to a 401k is you're getting a tax benefit later on. And so normally, and again, there's not a one size fits all, but if you're anticipating your income to be higher now than it is going to be in retirement, it makes more sense to contribute to a traditional IRA or to a SEP or to a tax deferred 401k contribution, because you're in a higher tax bracket now than you're going to be in a Roth. Whereas if you're anticipating having more income later on, or you want to have tax-free income for whatever reason, then it makes sense to contribute that to a Roth. Now you can if you have a SEP or a 401k that you've previously contributed to, you can roll that over into a different plan as long as it's a deferred account to a deferred account. You can roll those over, which happens a lot where you've been working for a hospital and you've had a 401k. You start as a locum, you want to set up your own account. You can roll that over so that all of your assets are under one retirement account. You can roll that over absolutely to make sure that you've got control over that.
Wonderful. That's great. Alexis, anything you want to add, and maybe anything about this very vague general question of how much? I know Skylar and I, when we work, I just every month, I'm a big saver. I don't know, I don't spend that much. So I try to max out my SEP IRA every year, every month now. I know I feel like as physicians, we feel delayed because we start so much later, but one of my old accountant friends says, you guys catch up pretty quickly. Well, not all of us, I guess the ones that, save money and don't go out and buy $5 million homes and 4 Lamborghinis, but that's kind of been my strategy. And then I think anything else, as I was saying before, my financial planner is just like, the more you save, obviously, the better off you are. But yeah, if you want to jump in on that one.
Yeah. So a couple points about retirement. One thing, especially, since it's coming July soon and people might be coming out of residency and going in, and then starting up and having a real salary, doing locum work, is to actually take advantage of this lower tax bracket that you're in. And so if you've been doing retirement contributions, or maybe even, by some glorious reason, your residency program actually has allowed you to put away into a retirement, a pre-tax retirement, it might be a good opportunity to take that those retirement pre-tax accounts and roll it over or convert it over to a Roth, and take advantage of this lower tax bracket.
Alex, let me stop really quickly. Can you also, before you finish, can you talk about, somebody asked, which is a really good question. I don't actually understand that well, the backdoor Roth, because I know, and correct me if I'm wrong, physicians make too much to have a Roth IRA from what I understand, but you can do a backdoor Roth IRA.
Correct. Yes. And this is why I don't recommend SEP IRAs, except to if you didn't get a chance to set up a 401k by year end, because it has to be set up before December 31st to count towards the year the prior year. Then you can do a SEP IRA and then roll it over quickly to the 401k in the current year. And so the thing with the backdoor Roth, so you're correct. As physicians, I think it's like 150,000 or something along those lines. If you make more than 150,000 married, then you cannot contribute directly to your Roth. So that's your $6,000 a year to your Roth. However, if you make too much, what you can do is what's called the backdoor Roth. So you contribute to your traditional IRA and then roll it immediately over to a Roth IRA. So since you're already contributing, so when you contribute to the traditional IRA, you cannot take a deduction because obviously you make too much. So you're contributing with post-tax dollars. So you've already paid tax on it. Right. And so what you can then do, since you've already paid tax on it, you've paid, or you have basis in it, you can then move that money from the traditional IRA to the Roth IRA tax-free. And this is something that you should be doing every single year. When you're a resident, you can do it as well. If your income's low enough, you can just do it directly. Once you get over those income limitations, then or maximums, then you can do the backdoor Roth. And so if you have a SEP IRA set up, then you get into something called pro rata rules. And what happens is the IRS goes and puts together the SEP IRA along with traditional IRAs, simple IRAs, any of those individual retirement accounts into one bucket together. And so if your balances in any of those IRAs is not zero by the end of the year, then even though you've already paid tax on it, you can, if you do that backdoor Roth, part of it will end up being taxable. So it's extremely important to go and make sure before December 31st that you don't have any SEP IRA, traditional IRAs, simple IRAs open, or you can have them open, I should say, they have to be zero balance. And then that way, you can do your backdoor Roth. Now, you don't have this issue with the 401k. It's not the same type of, it's not an individual retirement account. A 401k is a business account. And so you're able to have a balance in your 401k and go in, still do the backdoor Roth. Now, if you already have a SEP IRA open, or you have a traditional IRA open, you can just roll all that money right over into the 401k. It stays pre-tax. It won't get taxed at all. And it's just a rollover. So, it's an extra way for you to do the 401k, to hopefully max that out at 58, depending on how much you earn, as well as then putting another 6,000 for yourself. And then also you can, if you're married, you can do it for your spouse as well, even though they don't work. So it's really powerful and allows you to put away a lot more. When it comes to your question about how much do you need in order to retire, you have to figure out how much you're going to need in retirement, which it sounds like it's a big hypothetical question, basically. And so you have, there's a lot of calculators out on the internet that you can kind of do like a rough calculation, and you can do it they'll ask you, how much do you think you're going to need for living expenses? So let's say like $300,000 a year. How much are you putting away right now? What's the current earnings on it? And it will figure it out and tell you whether or not you're kind of on your way, or you need to be putting away more. So in order to really dig down deep and get you like good solid answers, you have to do a financial plan for that, and put all the different factors together.
Okay, wonderful. That's great. Thank you. Do you guys want to talk about, or Skylar, do you want to field the question about travel? I travel, as you see from my bank accounts, I travel all the time for work mainly. And what is deductible? Obviously, I deduct the rental car stuff, the hotel stuff. Somebody asked about food stuff. Is there anything that's not deductible when you do the travel?
No, I mean, pretty much everything as you're traveling for a specific job. I mean, meals while you're away are deductible, although they're deductible only to 50%. So there is a limitation to how much you can deduct on your meals. But yeah, any travel, if you're flying somewhere, that's deductible. Your hotel, if you're staying at a hotel, is deductible. Car rental is deductible while you're traveling. So pretty much anything that you're deducting as you travel is deductible. It gets a little bit more, I guess, more complicated, as Alexa mentioned. If you're doing a project that's close to your home, normally commuting miles are not deductible. But if you can establish a home office, travel from an office to an office is deductible. They're not commuting miles, and so you can take those in the deduction or as a deduction if you're working closer to your home. But as far as travel, it's like the rule is kind of anything ordinary and necessary in your line of work. And so if you're traveling and, you know, almost everything that you do traveling is deductible. Now, if you go to, let's say, a football game while you're traveling, something like that is not deductible, though. A lot of clients try to claim something like that, but anything that's in the ordinary course of business, right? So you're going somewhere for work, you have to go there for work, and then yeah, that's deductible. Meals you have to eat while you're gone, whether it's you go to the grocery store and you're buying some meals to eat in your hotel room, or you're going out to eat at a restaurant, those are deductible. But more of like the entertainment type of things are no longer deductible. They used to be deductible to the extent of 50%, but those are no longer deductible. The meals still are up to 50% of whatever the cost is.
And Alexis, and I'm sorry guys, there's so many great questions here. I wish we could get to all of them. Alexis, do you want to talk about the disability and the health insurance? Obviously, as I understand, which we do, run them through the S Corp for deductions, as well as an HSA, because I've been told, and I have an HSA, if you have a high deductible plan, it's kind of like a Roth to some capacity. There's unbelievable savings tools with an HSA. I have to get an emergent gum grafting surgery. I know, stop everything. And it costs about $9,000 from 3 different perios, which clearly, haha, what profession did I choose? But yeah, I mean, that's a lot of money, and insurance is laughing on the phone when I even call them about covering that. Yeah, you look closer, you can't see it. It's like way up high. But anyway, so you want to talk about, I think a lot of people have questions about how to go about it and the HSA stuff. And I'm about probably due to get cut off again. So we get cut off, I'll log right back on, but go ahead.
Okay. So I'll start with disability insurance. I actually recommend not writing that off through your business. And that's because a lot of times, or actually not a lot of times, all the time, if you write it off through your business, then the benefits that you get out are going to be taxable. So you really need to I would just pay that out of your personal pocket and not run it through the business. When it comes to health insurance, one of the best things to do, especially if your spouse works, is to try to get insurance through them if they work for an organization or employer, because a lot of times that'll be a lot less expensive. However, you can, if you're not in that situation, you don't have that available through your spouse, then just going onto the market, trying to find even private, you can go and deduct that through your business. However, as an S Corp owner, if you go and deduct it through the S Corp, then you have to add it back to your W-2 wages in order to satisfy, it's basically your 2% owner. And so it almost acts as a bit of a wash in a way. So you need to make sure that you're doing that. But one good positive about it is, one thing we really haven't discussed is reasonable compensation when it comes to defining your salary within your S Corp or C Corp. You can actually use that health insurance. So let's say you pay $20,000 a year in health insurance, that can actually be part of your compensation, and then you don't have to pay yourself as much in wages. But one thing to point out too with the health insurance is that although you're being taxed on it at a federal and state level, it is not subject to Social Security and Medicare tax. So you do save a little bit on that. Now, talking about the HSA, it's by far my most favorite tax strategy or available vehicle. Yeah, no, I love it. I love it.
Podcasts and blogs, and I was reading about it more, and I'm like, why have I? Yeah, this is recently, but yeah, I'm sorry, go ahead.
So yeah, you have to qualify for it. So if you just Google HSA IRS requirements, it easily pops up, and essentially you just have to be in a high deductible plan. And I think married, it's like $2,700 is your premiums, or your deductible, sorry. And then it has to be only allowed like $13,000 of expenses or something like that along those lines. It changes with inflation every year. And so what happens with an HSA, if you qualify, the money you put in is a deduction. It grows tax-free, and then it comes out tax-free when used for healthcare, so right. Medical, and that's not just co-pays. That's eyeglasses, contacts, dentists, all of those sort of items. And so the one thing that people will do is they'll just contribute to their HSA, and they'll bank all of their receipts. And what you can do is just save them in like Google Drive. And then when they go to retirement, they'll go and take that money out. They'll submit the receipts at retirement time and then take that money out and then use it for whatever. So it doesn't have to be, if you paid for something, you have to have the HSA set up at that point. But if you paid for something, today, you can submit the receipt 30 years from now and get that money out. It's also important to point out with HSAs that sorry, I just had a bit of a brain fart. Yeah. There's so much great things.
You look like you're going to heaven. There's like a sound.
I know.
It's like kind of cool. It's a cool effect on that.
But yeah, the sun is, it's definitely becoming spring. The sun's doing its own thing.
Yeah.
But yeah, so the HSA is really great. One thing I wanted to point out as well, when you go to, if you take it out for medical purposes, then it just acts like a regular IRA, and you pay tax on it at that point at your ordinary tax rate.
After 65, you can pull it out anyway, still for non-medical stuff. Is that true, or without getting penalized? Maybe no.
I'm not 100% sure on that. Oh. It's my understanding that you can still, you don't get penalized, but you can take it out, but you'll be taxed on it.
Right, gotcha. That's what I meant.
Yes.
Okay.
Yeah. Sorry. Okay. Yeah.
Wonderful. Well, guys, this is great. We have like maybe 1 or 2 more minutes. Nobody's stormed in here telling me to go see a patient, so I think we're good. Do you guys maybe in like a minute just want to talk about maybe like one or either a piece of advice or maybe a mistake that you've seen with physicians? Because my financial planner calls them the DDDs, dumb doctor decisions. Boy, do we make a lot of them. We have like a little target on our head of, hey, you want to invest in this new strategy? Hey, you want to do that? So maybe like a piece of advice, and maybe something you've seen, like a mistake somebody's made that maybe could have navigated it better. I think I was pretty blind about my own taxes for a while. My father's a physician, so I've been using his people, and I don't think they did anything bad. I think that just the communication was poor. I also probably should have gotten a little more involved in understanding all the benefits we can have. And so I then started seeking out, I don't know why it hit me one day, why wouldn't there be CPA companies like y'all and other people that specialize in locums and multi-state taxes and ways to, provide us tax benefits. And so, I made that transition, and I'm not sure, Alexis, I don't know how your model works, maybe similar, but I like the idea of Skylar's company. I have no financial interest in Skylar's company. But I like the idea that it's a all-in-one where you get your bookkeeping, your personal, and your business. And Skylar and his people are very accessible, and they answer questions quickly. They explain things well, and it's just a good relationship because I think physicians, we come from a very distrustful side when it comes to finances. So Yeah, Scott, if you want to maybe spend a minute chatting about that, and then maybe Alexis, and then I'll just wrap up. It's okay,
Yeah, so,
Alexis, I like that heaven effect. You can go for it.
I know, I can't get away from it.
Yeah. So I guess the last thing that I would say is, and now obviously there are a few things that you can do on your own, but is to surround yourself with the right people.
Yeah.
And not just be stuck with status quo. If you've got someone that you're not comfortable with, there's obviously other people out there that can help you. So if you're uncomfortable in your situation, don't be afraid to go and try and find someone else. If all they do is solidify what you're doing, then you've got a second opinion. Same thing with the doctor, right? But surround yourself with the right people. And you know, one thing that we've tried to do is to set up a team for our locum, so that it's not just it's kind of a one-stop shop. We have financial planners that we work with very, very closely to come up with a financial plan that works well with their tax situation, and that we're working hand in hand to make sure that your needs are being taken care of. Like Dr. Patel mentioned, we try to set up our shop so that everything's taken care of on the back end as far as taxes and finances go, so that you as a doctor can focus on what you do best. Not to say that you don't necessarily need to know all of the ins and outs of what we're doing. So my I guess my advice would be is make sure you're surrounding yourself with the right people that you can trust, people that you know will give you an honest answer. And one thing I learned when I was going through accounting school is I'd rather be awake at night wondering how I'm going to pay bills than lying awake at night if the IRS is going to be knocking on my door. So, you know, there's certain deductions that people will try and take, and normally those deductions aren't worth the risk of being audited or of getting caught, because the penalties can be pretty severe. It's there's no silver bullet to pay no taxes. Taxes are going to be paid. Uncle Sam's going to get his cut. And sometimes I'll be honest, it's just not worth the risk that's associated with taking those deductions, especially if they're not done correctly. If you're trying to do them yourself, or there's certainly tax strategies that you can take advantage of and make sure you're doing them right. You're working with the right people to do those, but surround yourself with the right people, with the right team, and you know, you can sleep better at night knowing things are handled properly and well, so that you can focus on your business and on your life, which are the most important parts.
Absolutely. That's wonderful. Thank you. And Alexis, do you want to just finish off?
Yeah, definitely. So probably, I mean, Skylar kind of hit it on the head. When you're working with someone, you want to make sure that they're actually teaching you. You know, I wrote a book, Advanced Strategies for Medical Professionals, and it's on Amazon. You can find it on my website as well. And basically, it was just a big brain dump of different tax strategies. And the thing is that you can go out there and you can learn all these strategies and you can read about them, but that's like the 80-20 rule. 20% is knowing the strategy, 80% is actually knowing how to do it properly. And that's where a lot of locum docs get in trouble, is that they say, hey, I can set up an S Corp easily, no problem. Well, there's a lot of other steps that are involved with it. With my with Cerebral, you know, we're going, and you know, not only we start with, when it comes to your financials, we look at your tax. That's the foundation of a great financial plan. And then once we've designed a plan, we've got you optimized for tax purposes, then we start implementing those strategies and get you into maintenance and making sure we're being proactive and continuing to tweak and modify that plan as we go along. So I'm working with financial advisors, we're working with attorneys, retirement experts, just to make sure that everything is being done properly. And you know what, most importantly, that it's easy for you guys, because face it, you're busy and you're an expert in what you do. Let us take on those burdens and make your life easier. So one other thing I want to point out, which I don't think we really didn't discuss, was making sure that you're paying estimated tax payments. That's probably one of the biggest mistakes I see locum docs do, is not making those quarterly payments. And you can be hit with a lot of penalties for that. So that's my little capstone advice.
Funny, I think we're doing that right now, Skylar, from transitioning between CPAs. Yep. So, well, guys.
Oh, that was unfortunate timing.
Oh, no.
Right
Dr.
about the
Patel?
half-hour mark again.
Yeah, maybe it's something that happens like,
Alexis, Scott, this is such a pleasure. This is like great. And I lose my and I got there. All right, guys. I cut off right at the end. I knew it was
Yeah,
gonna
you
happen.
did.
So such a pleasure, guys. Thank you so much. This is from Locum Stories, our two wonderful CPAs. This will be recorded. It's already being recorded. Will be on the website. Please go to locumstory.com. We have all these great videos that Locumstory does. Great team that puts all this together, brings up the speakers, and thank you.
thank you so much. I appreciate it.
Thank you
Thanks,
very much.
guys.
I appreciate it.
All right, guys. I'll catch you guys later.
All right.
Bye.
Bye-bye.
Bye.